Up next, we have the Crypto and Web3 panel. Joining the panel, we have investors that will talk about the digital asset, but also how to differentiate between the noise and the credible information. They will discuss DeFi, transactions, blockchain, and many other aspects that are happening right now. They'll also talk about regulations and the future of the industry. Moderating the panel, we have Jonathan Padilla, CEO and founder of Snickerdoodle Labs. Please take it away, Jonathan. Thank you.
Great. Thanks for having us, Claudia. And we have a phenomenal panel here today. I am actually calling in from Consensus. The team here at Snickerdoodle is hitting the floor, but we have a great group of panelists here. Maybe we can start off just by doing some intros amongst the panel. We can dive into some questions I've prepared. But maybe starting with Hector, we give a brief intro, then we'll go Carlos, Christian, Trevor, Cheryl, and Betsabe, and we can go that way. How about we give a brief intro and just kind of describe your role in the space and where you're at right now within the ecosystem.
Awesome. Thank you, Jonathan. A big fan of you and Snickerdoodle. So good that we're out here in Austin at Consensus. I think a few of us are. So looking forward to getting together. My name is Hector Martinez. I am on the institutional sales team at Anchorage Digital, which is the first and only active crypto bank in the US. So working alongside institutions that includes pensions, family offices, endowments, hedge funds, crypto native and legacy finance institutions. So glad to be here, and thankful to Emmanuel, Alexa, and HHF for the opportunity to speak.
Thank you. I'm currently based in London. I am working on a startup called ArcStreet. We are building a DeFi infrastructure project. We're seeking to tackle what we think is $1 trillion market opportunity, and one that's very pressing currently, which is blockchain treasury management. So we are actively right now talking to investors for a seed round. Just got our first commitment today, which we're really, really excited about, and going through IC process for quite a few other investors, including one group who's actually on this panel. So happy to be here.
Hello, everyone. Christian Narvaez, happy to be here. I'm currently part of the capital formation and business development team at OP Crypto. It's a fund where we have two vehicles, and the first one being a $50 million crypto fund investing in decentralized finance, the metaverse, DAOs, and the creator economy. The second one being a fund of funds vehicle, sort of where we look to back the best people and communities with a strong focus on VC funds in emerging markets. Besides that, I'm also the co-founder of Web3 Familia, which is an education platform or community with a mission to onboard 1 million Latinos into Web3. I'm excited to be here and obviously hear what else the rest of the panel has to share.
Hi, everyone. I'm Trevor. I am the founder and CEO of Copa. We are a marketplace that does real estate. It's a Web3 marketplace. We're making sure that people have the opportunity to own their world by being able to, anyone to get able to invest no matter what their income is, and to have access to assets all over the world. Really excited to be part of this panel and look forward to the discussion.
Hey everyone, my name is Cheryl Campos. I am the head of venture growth and capital at Republic. We are now a unicorn that allows anyone to invest in startups, both accredited and non-accredited. We are also really big in the crypto space, having gone through the 2018 crypto winter and kind of rebuild to help advise projects from incubation all the way through token sales. So seen, everything from the gamut since 2018. And then I'm also a direct investor as a scout through Lightspeed, and an investment partner at the Community Fund, a $5 million fund that invests in community-centric startups that fits very well into Web3 as a whole. And last but not least, I'm co-founder of VC Familia, now almost 300 Latino VCs strong, that really helps support one another, very inclusive, authentic community. That is also trying to support more Latino founders. And last but not least, it's my birthday. So happy to be here in this panel today.
Happy birthday.
Thank you.
Hi, everyone. My name is Betsabe Botaitis. I'm also in Consensus, so I'm looking forward to see you all, for those who are here in Consensus. I am a executive, a fintech executive, primarily, and I have served several CFO roles for hyper-growth companies. I'm also an entrepreneur, a blockchain entrepreneur. I co-founded a company, Icon, which is blockchain solutions for businesses, and the goal is to make blockchain a lot easier and simple. Most recently, I was leading a wealth tech company in digital assets, which really allowed me to observe and identify a lot of the trends in family offices and all around in the investment world, how digital assets are being a new asset class, and how is that a new asset class assessed and leveraged for many different purposes. And I'm super, super happy to be here.
As you can see, we have a phenomenal panel. Let's dive into questions. I'll have some questions for each of the panelists, and then we can have maybe more of a free-form conversation as we go into the next hour or so. Hector, I want to throw the first question out to you. Digital assets are now mainstay in many institutional investor portfolios, yet we're in the situation where regulation is uncertain, insurance options are limited. How can a trustee ensure their portfolios have exposure to digital assets while mitigating risk?
I think the best way is to ensure that they're working with some of the most regulated institutions in the space. For example, Anchorage Digital, as I mentioned, is the only active regulated operational bank at the national level here in the US. And so as a bank, Anchorage satisfies the custody rule, which means Anchorage becomes an unambiguous qualified custodian per SEC guidance. This is most crucial to RIAs that have a requirement to use a qualified custodian, but signals a level of trust, transparency, and regulatory status that isn't yet too commonplace in the crypto industry.
As a follow-up there, how do you see the products being offered? I know Anchorage, in disclosure, customer of Anchorage. How do you see?
You're not the only one, Jonathan, but thank you for the shout out.
There you go. But how do you see the kind of access to some of these liquidity pools and like the risk of putting in, if you have a custodianship with Anchorage, accessing some of these types of DeFi things through the platform? How do you see that necessarily impacting with something like a Compound or an Aave or these other types of products?
Yeah, that's a good question. And I would definitely encourage the audience to just maybe in the chat, let us know kind of your background, your interest in crypto, just to get a sense on how deep we want to go, right? There's folks, I heard on the last panel that may be exploring investments in Web3 or crypto, or maybe not yet. And so there's still a level of understanding that's required. And DeFi is something that, as I'm sure Carlos will touch on, becomes something that is a little bit more in depth as it relates to someone's initial crypto journey. But in terms of what Anchorage is willing and able to do is to provide a regulated platform that enables institutions to safely participate in the space. Being a qualified custodian, being a regulated bank, and being able to conduct activities such as custody, trading, financing, staking, governance participation is what Anchorage enables so that institutions can feel safe when they interact with digital assets.
Got it. Appreciate the answer there. Betsabe, let me go to you next. You have a phenomenal background as a CFO in the digital asset industry. In your kind of expert opinion here, how do you see digital assets and frankly Web3 more broadly transforming macro financial services, pensions, accounting? What do you think that perspective looks like, say, the next 5 to 10 years?
That's a very big question. Each of them can be a panel for some, but trying to summarize, I really see that definitely financial services are going to be challenged by decentralized and decentralization. Primarily, we're going to see it in payments. We start seeing a lot of new technologies and new startups coming out in Latin America. There is a huge need in emerging markets. So we're going to see it in payments. Most recently, in my experience of wealth tech, one of the things that we saw is really using the technology for heritage. Like, how do you transfer the heritage through instantaneously without having to go through all the legalese, and being able to have, let's say I am a kind of individual and I want to have my fund, I want to have my investments that if something were to happen to me, automatically via smart contracts can be transferred to my beneficiaries. So that I see to be a huge need worldwide, and the wealth tech industry exclusively for digital assets is booming. I have seen this boom in the last 8 to 12 months. Because now what we're seeing is that wealth management, what most high net worth individuals and family offices are trying to do is starting to focus into allocating to these new asset class between 10 to 5%. And what I see in the next 5 to 10 years is that we will get to that 10% of allocation as another diversification mechanism. But what I'm very excited about financial services in DeFi is really this inclusivity, allowing the underserved and underbanked, as we have discussed it for years. But really, these technologies allows to enable anyone to have a wallet and be able to transact and buy products online without having to have a credit card. We still have problems in the traditional financial systems how to price the risk of an individual. And I think that decentralized finance is going to get us closer to do that. So, and it will also allow more and more individuals to hold their assets. So everything that is budgeting, saving, and being included, the financial inclusion aspect is very important. It's also important to know, in spite of what we have heard about Luna and Terra, stable coins are incredibly important. And they are part of the ecosystem and they're here to stay. As a CFO, I think that there is a lot of things to do still. There are not enough accounting systems that allow us to lose the ledger, but it's a ledger. It is uncorrupted ledger. So once we have those tools, which are being in development right now, there's a huge potential. Once we have those tools, we will streamline processes. We will have better auditing functions. We will not have to depend on banks, on intermediaries to be able to get BAI files to be able to know our transactions in a real time. So the ability to have real-time data to make decisions at all times with monies, where your assets are through a ledger, that is very powerful. But we're still a little bit far away from that, but that's the ultimate vision. With regards to pension funds, it's something that I haven't really explored much, but what I mentioned earlier is digital assets are a new asset class, and they are here as a diversification mechanisms. So once they adopt it, will fuel and encourage to adopt accounting systems that are more auditable and uncorrupted based on the DLT or blockchain.
Great answer. And we'll come back to stable coins a little bit later in the the panel here. I think there's a lot of folks there, and I designed PayPal stable coin, so I have some nuance there in figuring out how this could play out there. But let me go to Cheryl. Cheryl, digital assets and frankly Web3 are moving faster than some of these TikTok trends out there. You know, we have a lot of investors concerned that we'll see a repeat of the 2001 .com bubble. And after the last 2.5 weeks, there might be some credence there with some of these coins, you know, basically looking at it 70 or 80% retractions. I mean, what do you think are some of the most compelling developments in Web3 that investors should consider? And how do you mitigate some of that risk in light of the volatility we're seeing across major cryptocurrencies?
Yeah, so I mean, I haven't checked my portfolio in a hot minute for a reason, trying to keep, calm during these times, because at the end of the day, this is a long-term play. What I think a lot of people react negatively to, but I think is a good signal, is the fact that there is more scrutiny and regulation that's going to come into this space, which I think gives legitimacy to the fact that, you know, this is something that is here to stay. We've seen it in other areas too. I know Republic, we are super compliance, regulatory focused in order to make sure that all the startups that we help and all the crypto projects that we help come to life are at least following the rules that are currently in place, and there will be more. So it's going to be good and bad. It will help, weed out some of these bad players that some people are referring to as crypto, Ponzi schemes or just pump and dumps. And so that's the type of thing that I think will help the industry overall. But at the same time, it will at the end of the day become more mainstream. So a couple of the applications that I think are really important are, to Betsabe's point, actually DeFi I think is incredibly powerful because it will take a lot of the middlemen out of the space, whether it's through smart contracts for buying a home or peer-to-peer lending or insurance. I know that when I bought my first house, that was there were so many different people that wanted money in different places that I think through smart contracts you're able to do it quite or at least simpler and more transparent manner than just paying fees left and right, not really knowing why they're there. And I also think another really cool trend that more people are talking about that I want to highlight is by making crypto more accessible to people just by integrating it into their everyday lives. So the move to earn play, I think is pretty interesting because people are already, giving their data to Nike and Strava and like we're already doing exercise, but it's a great way to also earn money and crypto along the way. And so, we have different applications like Sweatcoin or Seven that are gaining steam, and I think could be really awesome to not only get more people to benefit from what they're already doing, but at the same time, there are more kind of far-reaching applications around using that to maybe get better insurance rates or other things that will help increase a healthy lifestyle. So crypto at the end of the day is so, and Web3 as a whole, like will really help permeate into different sectors that may not have kind of crypto in the front end, but will definitely have crypto in the back end and overall align incentives.
And just a shout out to Sweatcoin. I have most of my employees at Snickerdoodle were actually doing an internal competition to see if they can beat me at a Sweatcoin challenge. So it's actually really cool product.
I'm not there, but add me because I'm a premium user. I'm out here every day.
Double the steps there.
Doubling the steps. So,
You got it. And just maybe really quickly on, as you think about developments, how do you see, we talk about accessibility, this notion of L2s and reducing gas fees as a way to bring more people in the ecosystem? Do you think that will have a positive impact?
I mean, yeah, actually, I think L2s are just as powerful if they do have lower gas fees, if they, have real applicability besides just whatever they're touting. And at the end of the day, like Ethereum is a clear example of something that just with the height of NFTs really, cost sometimes more than the NFT itself. And so if we do have lower gas fees, I think we'll make sure that more and more people are able to adopt this and integrate into their everyday lives.
Yeah. Trevor, let me go to you. I mean, you're doing some really fascinating stuff in the DeFi space, as a founder and startup leader in this sector. How do you see raising capital in DeFi, which is decentralized finance? How do you see that broadening and diversifying the investor pool? Do you think this is something that could benefit institutional and individual investors? And maybe how does this impact, first-time founders more broadly in the crypto ecosystem?
Thank you for the question. And I want to piggyback on everything Cheryl said, because I'm basically building this for real estate. So we're focused on low fees, we're focused on low minimums, a large selection and high volume and mass adoption to get more people into crypto and make it more of a regular way of life. And so part of what that is in terms of funding is it is very helpful for, like you talk about individual investors. It gives them an additional incentive, not just to put money in, but to participate early into projects if they have something that they really like and they want to be able to participate with it as seeing as it grows. They get upside, so not just financial or economic upside, but they can also get utility from what a really good project should be able to provide them some kind of utility or governance as well. They can also voice their recommendations and questions for as a project starts to grow. So like, how do you what a question that you may have to ask, someone may ask early on for a founder like myself, I might be able to learn from that and then be able to change what my messaging is to make sure that it's very clear. And for what my project is focused on, we do a lot of education around not just what digital assets are, but what is real estate and how do you get money from it. And the last thing that people, it's very common in the Web3 space, but it's not as common in the outside investor space is community. So community and making sure that everyone that is into a project together has a similar interest and they all able to work together and say, hey, look, here's how I'm learning with you. Here's how I'm growing with you. For institutions, they get all that Plus, they get a particular first mover advantage because if you get to be at the project that's going to be a multi-trillion-dollar project, you give a chance to have some serious upside. But also with a lot of these projects that are coming into the fore that are more focused in the real world, like mine, you can actually help adapt a project to help you with your own actual portfolio. So when it comes to real estate, how can you make your transactions cheaper, faster, whatever else, and set that up so you work with someone like Hector, making sure that we have that baseline that an institution could be able to use and actually make them better off. And then for me, it's a virtuous cycle as a founder, because yes, you can get funding from a wider base, and that's what people focus on, but it's a lot more than the capital. So the feedback that you get from investors and feedback you get from customers that have a stake in the outcome can also help you accelerate your own growth by making sure you do it better and faster. The other thing too is you get to reward people by them having that economic upside, so you feel good about that, and also providing utility and governance for those users. And the last thing, everyone knows that CAC is super important, or customer acquisition costs is super important. When you have a community of champions who actually care a lot about your portfolio and your project itself, that means organic user growth, and that allows you to grow a lot faster with people who really care before you start spending a bunch of marketing dollars.
Makes a lot of sense. Trevor, as you think about institutional DeFi, what are maybe the one or two most important either technical or regulatory hurdles that can help, frankly, open the floodgates? As a lot of the folks on this call have fiduciary responsibilities, what either could government or industry do to help accelerate this move into institutional DeFi?
Well, I think there's two sides of it. I mean, the first side is that you're talking about essentially having some laws and some clarity, right? So the SEC, we know that's typically an issue also at the state level. We want to make sure that for someone like any entrepreneur on this panel, we're going to want to have some clarity to make sure that we're driving by the right wheels on the road. We're very focused on compliance as well. And all of our lawyers are saying, this is what we think to the best of our knowledge, but that can also change. So we'd love to be able to have that regulatory clarity. I think that's probably the biggest thing. There's also some ways to say, like, you can help, my project is going to be worldwide. So how can we get more of an American type presence in other countries to help them be able to grow and help create the rule of law and everything else in these places? So there could be some partnership with governments, because that could also help other emerging governments as well by providing capital in these places and actually making it more like they stay more with the US in the coming years.
Got it. Christian, let's
Jonathan,
go to you. Sorry, go ahead.
I was going to mention the regulatory clarity piece is something that our institutional clients, that becomes a concern for them. Yeah. We had a Senator Loomis who presented a bill around what regulatory body has what jurisdictional sort of guidance on digital assets. Things that maybe have been thought of as commodities like Bitcoin and ETH. Like, is that something that will be looked upon by the CFTC? Where does the SEC play in this role of maybe security tokens or tokens that have some equity component as a part of that? As it relates to institutional DeFi, oftentimes institutions want to know who they're interacting with. Has that institution been KYC'd? Do they know who the counterparty is? Currently, that's not something that's readily available for institutions as it relates to DeFi. So oftentimes, and I know you mentioned, we'll touch on stablecoins in a moment, the next best thing is digital yield products via stablecoins. The ability to, via dollars, via stablecoins, access 6, 7, 8% yield in a market that craves dollars, the crypto market, is something that becomes much more palatable for institutions making their first step. And so I know it's something we probably get into, but I want to just highlight that for the audience.
Yeah, and it's a great point. I mean, from the executive order that came out 90 days ago, there's a lot of stuff that we'll probably go over in the second half of the panel here. But I think the next 6 months will be very telling. I don't think the bill from Gillibrand and Loomis will likely make it out of committee this year, but we'll see the outcome from the EO and the White House, I think, have wide-ranging impacts. And the work my team at Stanford has been working on this, I think we've seen a lot of insight there, and there's a lot of excitement that this should be a first pass, at least on the agency and regulatory side from those bodies having at least some standards. But Christian, let's go to you next. Decentralized autonomous organizations, or DAOs. These are really exciting ways to look at digital partnerships with a consensus protocol that allows individuals to work in concert by a smart contract in ways that, frankly, remove a lot of centralization and hierarchy. Over the last, say, really 6 to 9 months, we've seen an explosion of DAOs, which was really kind of nascent a year, even 2 years ago. But how should institutional investors think about DAOs? What is the impact you think these will have on the macroeconomic situation? And as we think about, equity and justice, what type of role do you think DAOs have in this kind of effort?
Yeah. I guess just to take a step back and make sure that the audience understands, and for simplicity's sake, a DAO is just a collection of people working towards a shared goal with some type of token ownership involved. And with that, sort of, DAOs are still in their infancy with a lot of important choices that need to be made regarding structuring, hierarchy, efficiency and tooling necessary to support them. And then, overall, they have created platforms for global collaboration with strong access to capital and manpower. And we've seen sort of great examples with their presence engaging in the physical world, like the Constitution DAO or City DAO, and in the world as well, where they sort of democratize exposure to certain traditional exclusive vehicles, like decentralized venture capital. And 2 examples of those are Orange DAO or Decent DAOs. And I think DAOs have the opportunity to completely reinvent the current power dynamics in the long run. But again, there's still a lot of infrastructure that needs to be built to support this. And I guess I would just say, take your time to truly understand the underlying infrastructure and its many use cases. And it's something, from an education point of view, it's something that we at OP Crypto do with family offices and institutional investors, because since there's interest in the ecosystem and there's no structured way of learning it, it's sort of, we see it as something that must be done, and we must be proactive from an education point of view. Obviously, happy to connect with anyone who has more questions. And in general, we'll start early with a lot of education that needs to be done from a retail side, but also from an institutional side.
Great. We'll get into some of these topics a little bit later, but we appreciate the response there, Christian. Let's go to Carlos. Carlos, some of the work you're doing at Arc Street, really, really fascinating on how you're trying to kind of have DeFi, frankly, redesign tech and capital markets along with some governance. How do you think about the strategies that Arc Street is developing as a hedge against volatility, maybe some of the regulatory risk and uncertainty? What has been your approach and kind of inspiration as you guys approach these considerations?
Yeah, I think one thing, we're fully focused on trying to fix the market. I think there's a lot going on. So kind of just for context, one of the innovations that we're building actually has its roots in old school finance. There's a concept called an exchange fund that was very popular with high net worth founders, where the idea is that they would pool their concentrated positions into this fund, get back returns of the overall fund. And it's kind of the perfect vehicle for the current structure of current treasuries in the blockchain space, especially DAOs, in that most of them, they can have a couple $2 billion in one token, maybe 2. And this is common across all the blockchain treasuries at the moment. So we're bringing that approach. And what we intend to do with this from a portfolio management standpoint is bring an endowment investment approach to the blockchain market. So essentially, if you look at kind of an asset liability matching framework, one of the issues now with a lot of treasuries is that they're spending more than they're bringing in. So they kind of have a net negative, which creates this downward cycle. And there's other issues as well that we're looking to fix. So our goal is to have a positive relationship so that treasuries, either foundations or protocols, or even the solo founder, they can have their runway, which is currently very uncertain, very volatile, be shifted into something that's more stable and lasts into perpetuity. In terms of the actual portfolio management, we are using a systematic investing approach, essentially codifying and creating algorithms that incorporate the models that we already have from our experience building a hedge fund. Our team, we're fortunate enough that we have a pretty strong team of quants One of our guys used to lead blockchain research at JP Morgan for their CIO group. A couple other people have experience working with supercomputers and at places like NASA, Stanford, and the military. One of our token engineers, he's a core contributor of agent-based token simulation models, which that'll be a key component of having a sustainable blockchain infrastructure going forward, something that just got created over the last couple of months. And in terms of the actual models, these range from traditional, TradFi time series, GARCH, regime changing models that people are probably familiar with more on-chain analytics to forecast volatility or to gauge networks, specifically to look for wash trading. So this risk management approach that we're taking, our asset liability matching strategy only works if we can keep a positive relationship, which will be difficult. But one of the things that blockchain does really well is align incentives. So kind of to keep it concise, one of the things that we're doing is that in our current system, we have 4 revenue streams. In a normal state of the market, these will be used to accrue revenue and increase the wealth of the token. But in times of very volatile markets, we're essentially going to divert this revenue stream to ensure that our token and essentially the treasuries that we'll manage remain liquid through what is called the bonding mechanism, which is essentially we're going to issue 0 coupon bonds to incentivize capital to act in a certain way. So if we need liquidity, we're going to incentivize capital to deposit stablecoin. If our concentration limits in our portfolio get out of whack, we're going to incentivize depositing of different tokens, which will be essentially a decentralized kind of portfolio management type of framework. We're developing a decentralized research arm that we've already incorporated at the London Business School Blockchain Society, of which I'm one of the founders. So we're really excited about that and getting positive reception. I think with this new innovation, we hope that we'll create a more sustainable system that'll be less volatile. And in terms of regulation, that's obviously a hard part. We talked to a lot of lawyers and they recommended that the more algorithmic we make it, the better. And as long as we allow our community of token holders a strong say in what we're doing, that we should be fine. Although ironically, in the current state of the market without the regulation, we might actually have to create our DAO, which we want to become eventually in more of a closed DAO, where only high net worth and institutional managers will be able to participate. But if there's regulations, we would love to open it up to the broader community so everyone can kind of generate this wealth with us.
Let me follow up, ask a question. The Financial Conduct Authority there in London has done, I think, a phenomenal track record. I think, frankly, better than what we've seen out of Europe and frankly here in the US. They've had a very aggressive scheme for a fintech sandbox. Have you guys taken a look at looking at those types of applications to potentially get the regulatory approval to broaden this effort?
Yeah, for sure. Our company initially was going to be a hedge fund, so we incorporated in the UK. But now that we're doing a token issuances, we were recommended to structure overseas. But we would love a place that provides us clarity. One of the pros and cons of blockchain is you can have participants across the world provide capital very quickly, very easily, but it makes regulation very complicated. So if the UK, they've come out very strongly saying they want to be a market leader and an innovator. And we know people directly that are participating in those forums. A lot of our professors that we've spoken with are writing the regulation, and they've been asking us for advice at this point. So we're hoping that they can provide something clear. So London's always been a financial leader in the world. So hopefully it'll stay that way and we'll be able to pioneer with it as well.
Awesome. I'm going to change up the format just a little bit as we enter the second half. I'm going to ask a few questions, and I want people in the audience here to be ready with questions on their end. But let's go to stablecoins. I think this is something of critical importance to the entire crypto ecosystem. Just quickly, in my background, I was the head of global blockchain strategy at PayPal for about 2 years, designed a PayPal stablecoin that was, I think, leaked to the press back in January, so I can talk about it now. But, in light of what happened with algorithmic stablecoins, Do Kwon and Terra, which was frankly a cluster, it's the nicest way to probably put it. What does the future of stablecoin look like in a couple sense? And I want to throw this to the panelists. Are we looking at a situation where we have, one-to-one pegs like USDC and Circle? Are we looking at de-dollarization of stable coins where we have digital pound, digital euro, digital RMB? I mean, from your perspective, having worked in this space for a while now, what are some of the trends in this ecosystem do people expect to take place? And maybe what are the implications there as we look at capital allocations and broader impact of the crypto ecosystem? Does anybody want to volunteer to kind of start off?
I guess I can go first on that. Yeah, I think the stablecoin system and some of the experimentation going on there is definitely taking a step back. I think algorithmic stablecoins had a lot of promise, but they were just a rogue founder that clearly was creating something that was unsustainable and not matching his assets to his risk liabilities. But I'm hopeful with some of the new developments in token simulations. If you were to run his code, it would have shown right away that it would have been unsustainable. So hopefully in the future, VC investors and the savvy ones that we're courting for our cap table can run these, and some of them pioneer some of these systems. I think hopefully over time, there'll be a little bit more discipline in creating some of those. Because if the stablecoin market has to stay as fully backed, then I don't think blockchain will be able to fully break through and take over traditional finance or really unlock its full potential that I think it could.
I mean, Hector, you brought up chase for yield and how this could play with, say, the Anchorage ecosystem. I mean, how do you see some of these yields being sustainable on stablecoin and those demand for dollars? And how does that, you think, impact the kind of broader crypto investment scheme here?
Yeah, absolutely. Part of it is that institutions that hold a liquid digital asset position, Bitcoin or ETH, typically are unable to access liquidity if, for example, they have a low cost basis. So there aren't enough regulated institutions that can enable someone to collateralize a Bitcoin position, access a dollar loan that enables them to reinvest or use those proceeds for investment. Anchorage is one of those entities, being a regulated bank, that is able to step in, properly underwrite a loan, properly manage and liquidate Bitcoin and crypto as collateral, which is something that traditional institutions can't do. Some are starting to get into it, but there's a level of expertise that requires not only the security of the collateral, but also the properly managing and liquidating of the collateral, which is something that institutional clients get when they're interacting with Anchorage. The yields are, relative to, bonds or other fixed income products are high because those institutions that need liquidity on their position can't get that liquidity in a traditional bank. So they come to a crypto bank, a native crypto bank like Anchorage, where from regulatory perspective, Anchorage's position is clear, a regulated qualified custodian via the SEC custody rule that has the technical expertise and the compliance and credit expertise to be able to properly value, manage, and dispose of collateral depending on the market environment that we're in. So what that does is that it enables institutions to have a counterparty that they can interact with that is typical to the traditional banking relationships that they have, and access a yield on dollars, in excess of 5 to 7%. An example is Fairfax County and their pension in Virginia has been leaders in this space for some time. They've invested in funds, approaching and exploring digital yield investments as well, where they're making investments in funds that have a yield generating strategy that not only includes DeFi, but also may include traditional lending via an institution like Anchorage. And so for those funds that they're investing in, as it relates to their experience with an institution like Anchorage, they can always interact with dollars if that's what they prefer. They can wire dollars to begin generating yield. Anchorage will on-lend those assets to appropriate borrowers and KYC borrowers. And once they want to receive accrued interest, Anchorage will wire those dollars back to them. So the whole interaction with Anchorage is via any traditional method, which is just interacting with dollars. the comfort becomes how comfortable are they with crypto as collateral? And so, as I mentioned, Anchorage is able to not only value the collateral, manage the collateral, liquidate the collateral via an integrated agency brokerage that has access to that collateral. So it makes institutions that much more comfortable interacting with Anchorage, a regulated bank, interacting with dollars as well to capture a yield that they may not get in the traditional world.
Betsabe, let me go to you on the stablecoin question. We'll go to, I think, a couple other extensions in just a minute. And I want to make sure if you have questions, please start putting them in the chat so we can have those. But you have a great background focused on financial inclusion, especially on a cross-border basis. As we think about the utilization of stable coins, I mean, we think about crypto as a whole. Ripple was started nearly 10 years ago with this kind of promise of a very inexpensive, very quick settlement of cross-border transactions. How do you see maybe stable coins, or even if you want to touch on this more broadly, central bank digital currency or CBDCs, which audience you think about as simply state-issued or state-backed stable coins, impacting economic inclusion, the ability for folks to kind of transfer wealth very seamlessly?
Yes, that's one of my passions. That's why I'm in blockchain, because of financial inclusion. But so first, from my most recent experience, what I have seen in the payment rails, I don't know how many people in the audience have experience from Latin America and have trying to send $100,000 or $500,000 via banks. Sometimes it takes 48 hours or even 2 weeks for the money to be transferred. So that is not financial inclusion, but I just want to highlight an issue that as a treasurer and a finance organization, what I would love to have is a stable coin that I feel safe and secure and be able to transfer for my day-to-day operations. Now, moving into the financial inclusion part, what I see more and more is in a hyperinflationary microeconomic condition. We see countries like Argentina, we see a lot of issues right now with Colombia and potentially Chile. In hyperinflationary conditions, more and more of the new talent and the tech-savvy talent, they don't want to be paid neither with dollars, or they don't want to be paid with a home currency. What they want to be is having stable coins, so Bitcoin or Ethereum, depending on how savvy they are. And I really believe that this is something that is here to stay. More and more people will actually be able to access to financial inclusion and manage their money through crypto wallets, but they need stability because they are not investing. They're using the money that they make in a monthly basis. A very clear example of what I believe stable coins and in general cryptocurrencies are important. There is my co-founder of Icon and I, we used to tell each other that was a very good proof of why blockchain exists. When we started Icon in 2017, we have the fortune of talking to the team of the robotics, the robotics team from, I think that it was Iraq. I don't remember if it was Iraq or some area there. I think it was Iraq. Females that they share with us that the fact that they have a crypto wallet, the fact that they have stable coins or Bitcoin, and no one had access, not their husbands, not anyone on the female dominated, that they felt insecure, and that gave their power. So for the first time, this group of females that started learning to do robotics and start by self-taught, they start getting into competitions, and they got paid by stable coins at the time, and some of them by Bitcoin. That gives us the strength, and they are teaching their kids. And that's the same thing that I started to see in Latin America. I'm teaching my mother, who is not tech savvy at all, and she now prefers to do all her payments via stable coins and crypto. I think that is a huge potential for people to start feeling safe. I mean, we can recall, for example, I'm originally from Mexico, and I was in Mexico in 1994 when there was the famous crisis of the tequila, when the peso completely devaluated. I mean, that destroyed families. That completely turned around and took the wealth And even though we just see the most recent, what happened right now with Terra and Luna, many of that investments in Terra and Luna were speculative. So there has to be a balance. And I think there is going to be a balance between algorithm and collateralized stable coins, and that we have to do, every single of us as blockchain ambassadors, we need to do a lot of education because we are just touching the surface. But I do believe that it has a massive potential to transform, give freedom, as I mentioned, from the female robotic team, as all the people that I have met in Latin America, people that I have hired, and they want to be paid on crypto, particularly stable coins. That's empowered them. That gives them hope, and hope brings creativity. And if we help one person, we can help many more. I didn't know if I answered your question, Jonathan, but that has been my experience right now.
No, it's great feedback, and I think it's an open-ended question here. I want to make sure if the audience has questions, either feel free to ask or type them in the box here. Is there anything from the audience? I have plenty of questions and could filibuster for a while, but I think we have something from Alexander. Alexander, do you want to ask the question to the panel? Well, I'm not sure if he can talk, but it looks like his question is focused on basically DeFi payments such as Stellar, XLM, or Celo becoming widely adopted by people in Latin America. And sounds like if we think about kind of these kind of newer non-Ethereum based protocols, they have a potential to kind of streamline it. Do you see these things becoming perhaps widespread? Disclosure, I work with David Mazieres, who designed Stellar's consensus mechanism on a regular basis. But does the panel want to take any approach here on XLM or Celo might be more widely adopted in emerging markets?
I could jump in and talk slightly about Stellar and Celo, because I have seen very good projects that are now getting to the 3 to 5 million in revenue on Stellar and Celo. I have seen Stellar a lot more for microfinance in Africa, incredibly successful from in microfinance in Africa. Very good companies that using startups, Series C startups are using Stellar as their payment infrastructure. And Celo, I start seeing some good projects in Mexico, less more South America, but I start seeing some projects. I do believe that it's incredibly important to follow the developers. The way that I like to assess the technology is follow the developers. The developers are the ultimate people that are adopting technology, and they are the ones that are creating new ideas and solutions to real problems on the regions. And I think that there are so many. I mean, we have also Hedera, which is a DLT and a blockchain, and we have other ones that start coming on, and there is being used. But Stellar, particularly, has done a good use through the foundation and the grants that they are giving. So it promotes for developers to be able to adopt the technology. So I think that is a good change as long as developers keep liking it.
Let's expand on this. This is something of interest that I've had for a long time. And if there's no other questions from the audience, we have some phenomenal leaders in the space. There's a lot of different blockchains. And as we think about, just for the audience, you have layer ones, we kind of often shorthand as L1s. These are things like Ethereum. We have a lot of new consensus mechanisms and protocols out there that have kind of captured the imagination. These are projects like Avalanche and Celo and Stellar and Solana. As we think about this kind of notion of the future of Web3, how do people feel, and this is open-ended, really anybody jump in, about this notion of will we live in an Ethereum-only world 10 years from now, or do you think we'll have a multi-chain future?
I think there's going to be consolidation. Sorry, I'm jumping again. I think there's going to be consolidation. We haven't seen yet the winner. I mean, in 2017, there was a huge euphoria about EOS, one of the protocol layer 1 protocols, and it hasn't really done much. They had a token sale of $4 billion, and we haven't seen many projects. Now we see Avalanche and Solana, and Stellar coming very strong for more Avalanche and Solana. But I do think that it's going to be consolidation eventually. It's going to be a world we're going to first spend. And for example, the company I co-founder Icon, one of the things that we're doing atomic swaps to be able to do wrappers and connect multiple blockchains, because we know there is not a winning yet there. We need to have all the new projects need to have this ability, and we are a layer 2 protocol. And we need to have the ability to be able to connect across, because exactly we don't know what is going to be the winner. And I mean, as you know, Ethereum, Solidity, we don't have that many developers that can write Solidity. Yeah. And then C++, the new language of C++. I'm getting a little bit more technical here, but that's how I have heard many of the native investors in blockchain and assessing the investment. So really, how is the tech stack behind? And I like to see competition first, because each one is getting better and better and better. Now we have the ability to recover the keys and so on. But it's going to be consolidation. I think that ultimately we're going to have 5 to 4. We may have 4 to 5 permissionless and 3 or 4 private ones.
Cheryl, Trevor, Christian, any thoughts on this kind of notion of the so-called protocol wars? What are your maybe thoughts, thesis on these types of things?
Yeah, I'll just jump in real quick. It's incredibly hard to bootstrap a layer 1. I think you do need like a war chest and lots of activations to make sure that there's a real ecosystem and you attract the right developers to go and actually build on it. I've seen it in several, and in Republic, we helped with both Avalanche and Solana have come out, but I just personally always like to look at, whether or not they are truly scalable. I know Solana has had a lot of problems in the past and making sure that things are verified, but, it's at the end of the day, definitely multi-chain is key for now. I 100% agree that there will be some consolidation. Because you need a war chest, a lot of people will run out if they're not actually doing sustainable ecosystem building and community. Quite frankly, it comes down to whether or not people will fight to keep it alive or just transfer somewhere else. I know Polygon has been benefiting a lot from some of those chains that have died or that have been attracting the right folks. So it's still anyone's game. We saw EOS before die. So it's just a matter of making sure that in whatever chain that you're able to support, you see that there's real longevity. And I think those that are truly going to be scalable and ones that are, I think regulators that will be more comfortable with are the ones that are compliant from the get-go. And so that's just my 2 cents there.
Yeah.
I mean,
any other comments on this question?
I could piggyback off of Betsabe.
Yeah.
Obviously, yes, eventually there will be consolidation, but for now, a multi-chain world is needed because, in America, our first world country point of view, right, we're creating or solving sort of projects to solve, friction points for our lives in a very sort of privileged world, whereas in, Venezuela, Argentina, Peru, Chile, sort of their everyday problems are different. And again, Betsabe hit a good point where sort of early adoption of the blockchain sort of in Venezuela and Argentina didn't come because of first world problems. It came because of an economic need, right? So I think sort of protocols like Near, Harmony, Algorand, Polygon for sort of accessibility at scale in a more affordable way. So I think for now we'll see a multi-chain world, but eventually, those who are the immediate need. A good example would be Celo. They are mobile first, low bandwidth, which caters to like Latam, geographies like Africa, where the infrastructure is not sort of as developed as America or first world countries. So for now, yeah, multi-chain world will continue, but eventually, sure, there'll be consolidation.
Let me actually do the next question from Carlos. I'm going to put it to you, Trevor. I think it's directly relevant to what you're building. But Carlos is asking here about verified credentials, and we could think about this as basically going through a KYC process. We've seen that recently with the government there in El Salvador as they've moved to basically onboard millions of people to have Bitcoin wallets. Another kind of notion we've seen in the last quarter from Vitalik and the kind of team at the Ethereum Foundation is this notion of soul tokens, or tokens that are bound to the individual, so that you have some sort of long-term connection to something that it can't be as ephemeral as some of these uncustodied wallets. But Trevor, maybe as we think about this in terms of what you're building in real estate and some of these real life applications, how do you see this verified credential effort impacting your business and maybe others? And we'll open this up to others after Trevor gives his answer.
For sure. I mean, I think for me, when I started thinking about real estate, anything that's going to be traded on the platform is going to be security, right? So we're going to have KYC, AML. Anyone that gets on is going to have to go through it. And so the fact that we're opening up something that has not been, I mean, we're focused on cash flowing assets and think of it more like a bond. The fact that we're operating something to people that have not had access to something like this before, if they say that they don't want to be, they're so pro privacy that they don't want to have to put themselves through KYC, then they're not a good customer for us. I think the vast majority of people would love to be able to have access to it, and that's what we've been seeing in the market as well. And so for us, it's more like, hey, our focus is on participation. Everyone gets to participate. Everyone is empowered to be educated and knowing what's happening on the blockchain and also what's happening with these properties, so that everyone has full knowledge. And that also means that you have to make sure that if the entire system gets taken down because we didn't do KYC AML, that means that everyone gets hurt by it and everyone's in this together. So our focus is very much on like saying this is why you need it, and not so much saying, hey, we're privacy first, as some other things kind of focus on. Yeah.
Christian or Carlos, I mean, as you think about DeFi and DAOs, I mean, how do you see this verification of the individual, as a Web3 kind of sovereign person? How do you see that impacting your respective sectors and any hopes or aspirations for where this goes?
I mean, I think some sort of, for Web3 maxis, they're obviously going to be sort of a different answer over sort of a commercial or retail sort of individual that wants to sort of engage with sort of the DAO structure. So I think there still needs to be different case studies to look at, or still go through different sort of facets of it. So I don't think there's a straight up question, sort of a direct point of seeing it. I don't know if anyone else has other points, but I'll leave it at that.
I guess I'll just add to that. At least in my perspective, I like the anonymous version of blockchain. I don't know why people want to verify identity. If it was really easy and we could potentially onboard millions of people in Latin America that don't have any documents whatsoever, then possibly that would make sense. But a lot of these people don't even have stable internet connections or laptops. So it's a different issue. But if you look at like El Salvador, for example, adopting Bitcoin, I don't think they're KYCing people to own Bitcoin, right? So I think the fluid nature of the liquidity and the tokens within the system are what could potentially enable this untapped market to be banked. If we're trying to go through the traditional route of we need to KYC everyone and it needs to be controlled, I think that'll limit the people that are able to participate. And I think in general, I think that genie's out of the bottle. I don't know if we can necessarily preclude or remove some of the more nefarious items within crypto at this point. I think it's too late for that.
Got it.